Hello, this is Eric Gordon. And today I have a topic that I want to hit on, and that topic is called an initial public offering or an IPO.
Please help us out by subscribing, liking, commenting, and sharing.
IPOs are very lucrative if done correctly. However, they can also be very sticky because you could possibly lose money. So what I want to do first off is I want to actually talk a little bit about what is an initial public offering. Well, let's take a company, ABC. ABC wants to raise some capital. They have desires to get stronger in the market, and they want to do more marketing and advertising, which takes dollars. They go to an investment banker. That investment banker will look over their financial statements, balance sheets, and figure out what price they can give to this company's security offering, because the company is taking a portion of their business and they're offering it to the public. And that company is going to say, we're going to put X number of millions of shares on the marketplace. And each share is going to cost a certain dollar amount. Once they conclude on that dollar amount, then they'll take that to the market and they'll actually launch it on the stock market. And you can go out there and actually buy that particular company's shares at that initial public offering price, which would make you an owner of the company. From there, that company is going to raise thousands, even millions, even billions of dollars over a course of time, over that particular day, because they need that money. And depending on how the market moves, whether it fluctuates, goes up or down, they're going to have some money in the bank at some point in time. Sometimes they win, sometimes they lose. So you have to be very careful. And I'll give an example of a company that I personally actually did an IPO with, which was a company called DraftKings. In April, DraftKings made their initial public offering at $17 per share. Now, because of the kind of guy I am, I like to sometimes wait to see what the market is going to do. So when it initially gave that offering of $17 a share, I stood on the sidelines and just held out a little bit. I held out actually for a day, because sometimes an initial public offering is great. It sounds good. The price is within my budget, and I may go out there and buy X number of shares, and it may skyrocket throughout the day. So let's just say, hypothetically speaking, DraftKings went from $17 to $20 throughout the day, and it was sitting there. It was sidelined at 20, 21, 20, 21, but toward the middle of the day, it started to kind of take a decline and drop down. And at the end of the day, at the end of the close day, they ended up at a price of $19 per share, which in my case, I actually bought DraftKings the next day. I bought it at $19 a share and I held out there. So at $19 a share, I bought me some securities there and I held on to it. Well, over time, DraftKings, that was April. Over time, to this day, this is December the 8th, DraftKings at today's close, this is Friday, December the 8th, closed at $58 per share. So as you can see, sometimes you can win when you go with a specific company. Answer the questions who, what, and why. Who is the company? Why are they trading right now? And what exactly are they selling? Well, DraftKings was selling the opportunity to do online gambling. And I know quite a few of my friends are online gamblers. And because of COVID-19, I knew that DraftKings was in a specific sweet spot so that people could actually buy something that made complete sense. We're already at home, but we still love to gamble. DraftKings was something that was very important to them because they enjoyed to gamble. So since then, if you just kind of take a look at some of the things that are being commercialized on television, some of the things you might see online, you'll always see something about DraftKings. And once I saw that, once I did a little bit of a technical analysis, once I did some marketing analysis, I noticed that DraftKings is going to be something that's going to be lucrative, and I purchased a few shares, and today those shares are worth $58. However, there's also times where a company may actually do an IPO because they're trying to raise money because they're in debt. You may not know it unless you do your homework. So I would always caution, answer the questions of who are they, what are they selling, and why are they trading on the stock market. Be very careful because sometimes they're in a crunch and they need money, and they need money fast. So you don't want to put your investment in there with a company that's trying to do an IPO so that they can get out of debt. So be very, very careful. So those are just a couple of different things that you want to keep your mind on. And also keep in mind, I didn't talk to a guy named Tom Tolley. I actually read some of his articles, and Tom Tolley, who is an IPO analyst, has indicated that typically around mid-December, IPOs will stop. You won't see them being offered out there until sometime in January. So right now, we've got one more full week of IPOs, which is the upcoming week, and we're probably going to be at an end. So if you are on TD Ameritrade, or if you're on Webull, if you are on Charles Schwab or Fidelity or Robinhood, take a look at your IPO calendars and see what's out there in the marketplace. If you see something that you like, just kind of go do a little investigation. See what they're offering, see what they have to sell, and find out why they're selling it. And once you do those few little things, you'll find yourself that you could possibly make a good bit of money, or you may find yourself in a bad position. So keep those things in mind. This is Eric Gordon with Cash is Trash. I appreciate you, and I'll see you on the next video.